Okay, well, it looks like attendee numbers are stabilizing now. So, welcome once again to the Ocean and Air Freight Tracker Outlook webinar for Q2 2026. Um, this is another really exciting quarter, really, in the air and ocean freight markets, and particularly, I think, in the air freight markets. Of course, we've seen the fallout of the crisis in the Gulf really impacting rates, capacity in the air freight market, and all on top of a softer demand market, but we're still seeing prices really increasing there. So it'd be really interesting to drill down into what's really causing the growth in rates in the air freight market. I think we all have some idea about that, of course. And equally in ocean freights, to look at the overcapacity situation, the impact on demand and flows, we're going to be diving into all of that really, because we still have that sort of delta between capacity increasing at a really rapid rate, record rates actually, I think in the next year expected of new vessels coming online anyway, and demand not really keeping touch with that. So a market that's not in balance, not to mention all the disruption that we're seeing. So really interesting. We've also got a few extra slides this quarter which really highlight what's going on in the Gulf, and we're looking at rates to and from the Gulf as well as what's happening with volumes and vessel transits and that kind of thing. So we should be able to put some really good highlights on that for you this time around. So before I introduce our panelists, I obviously just need to do a little bit of housekeeping, just to say that the presentation probably be about 40 minutes, 35, 40 minutes this time around, due to those extra sections. And of course, you'll get a copy of the presentation and reports after the webinar, as well as the recording of this as well, of course. And like usual, we'll have a Q&A session at the end, so please do feel free to submit any questions via the Zoom Q&A app throughout the course of the session. We'll deal with as many as we can at the end. And we'll also have our two polls during the webinar, one on ocean freight rates and another on air freight rates, to get your view as to what's going to happen to freight rates this quarter. So please do be prepared to answer those questions as well. All right, so moving on to introducing our panelists. I should introduce myself. I'm Michael Clover, TI's Head of Commercial Development. If those any of you who don't know us, we're a market intelligence and logistics firm dedicated to giving you intelligence on the global logistics market. So that's air and ocean freight, but also on warehousing, road transport, parcels and contract logistics, with strategic intelligence on top of the more operational intelligence we're providing today. And I'm also joined by our research manager, Vicky Kekarovska. Welcome, Vicky.
Thanks, Michael. Hello, everyone.
And Janan Hassan, who's one of our analyst team here and instrumental in all the data analysis for this report. So welcome, Janan.
Thank you, Michael. Hello, everyone.
All right, so we'll get to it then. First section, as always, ocean freight this time around, and we'll take a look at what's been going on in recent months. We can see there's been a bit of an uptick in rates, but possibly not as dramatic as we may have been expecting at the outset of the Iran war. But Vicky can hopefully shed some light on why that is and what's really happening underneath the figures here.
Yes, so you're right, Michael, to mention that this quarter, the recent months have been defined by the closure of the Strait of Hormuz to commercial shipping, and this event sent shockwaves through global ocean freight markets. And while this started as a geopolitical shock, it quickly became a very important structural cost event. So looking at the data, here we're seeing TI's global ocean freight rate index. It's showing that head haul rates in May were up around 5 points month on month and around 13 points quarter on quarter. And while this is a meaningful improvement compared to the first quarter of the year, rates still remain around 8 points below last year. And this tells us the underlying direction of the market without geopolitical support. And then another notable market characteristic has been the significant divergence across lanes. For instance, the Trans-Pacific lane stood out. Rates from Shanghai to Los Angeles in early May were 34% up, compared to the pre-conflict levels, driven, we know, by emergency fuel surcharges and peak season surcharges, even though volumes on this lane were quite soft. So overall, the key theme we're seeing here is rate spikes, which are largely driven by fuel cost pass-throughs and geopolitical disruption rather than genuine demand recovery.
Okay, yes, that's really interesting. So that tells us a bit more about the sort of underlying dynamics. And on the subject of demand recovery, we'll obviously have our slide here on volumes, which hopefully can show how modest that is. But what's your take on the volumes, Vicky?
Yeah, so the demand picture is mixed. And again, we are seeing a widening gap between what the data tells us on a global level versus what's happening at a lane level. So the TI's global volume index in the first quarter was up only 1.6 points year on year, but regional performance varied. Asia, once again, it was the growth engine. The volume index there grew around 6 points year on year, driven by strong Chinese export activity. And then on the other hand, we've got North America, which was the weakest region, and the volume index there was down almost 6 points year on year. And Europe was soft here as well. The volume index was down 3.5 points year on year as European importers are still quite cautious and they're holding back from restocking at scale.
Okay, thank you, Vicky. So yeah, soft picture volume wise, really. In terms of capacity, we've got here the data set showing capacity by lane, and Janan's going to show what's going on with capacity and how it relates to that volume development as well.
Of course. So on the capacity side of ocean freight, the supply continues to outpace demand by a meaningful margin. Global capacity reached around 1.25 million TEUs in Q2, and that's up 3% year on year. That does sound modest, but it's sitting on top of an already oversupplied market environment. And the order books tell the real story. It's now hit a record 13 million TEUs. Ships currently on order exceed the combined active fleets of Maersk, CMA CGM, and COSCO. And with 8% annual fleet growth projected for 2027 and 2028, the structural imbalance isn't going away anytime soon. And on the supply management side of the coin, blank sailings rose 122% in February. Slow steaming has basically become the default, but even with all that, idled vessels are still sitting below 1% of the fleet. Carriers are holding on to ships rather than scrapping them, which at least gives some flexibility. Meanwhile, demolition collapsed to a 20-year low at just over 8,000 TEUs scrapped in the whole of 2025.
Thanks, Janan. Um, So that's the capacity situation we're looking at, and normally we'd rock through the supply side situation, but because we're having this take on the Gulf crisis as well, we wanted to show specifically some rates for the Gulf too before we go on to the sort of cost side of the operation. So this chart here is showing us rates to the Persian Gulf, and Janan's going to just explain what's been happening here.
Of course. So what we're looking at here is the China Containerized Freight Rate Index to the Red Sea and Persian Gulf, at the baseline being January 1998. The index hit 2,245 points in May, and that was 23% up versus April and just over 51% up versus last year. And it's now double the long run average index value for this route. The operational knock-on effects spread very quickly. Hapag-Lloyd and Maersk suspended bookings into the UAE and broader regional ports. Cargo was also diverted to Oman, India, and Sri Lanka, which created congestion at those alternative hubs as they observed volumes that they weren't sized for. Shippers on affected routes ended up carrying emergency surcharges and extended routing costs and war risks premium all at once, which is what effectively raised rates at premium risk index for this quarter. The rates on Gulf-linked services more than doubled from pre-conflict levels overall.
Yeah, so obviously a very significant increase in rates there, but I think obviously the next chart is really interesting to look at because in terms of transits and access to the ports there, this really shows a complete collapse um, in the market with a few moments of recovery really. So it's interesting to think about it in terms of or in relation to the sort of increase in rates that we saw there. But obviously, Janan, you can shed some more light on this.
Of course, as Michael said, in February, around 130 ships were transiting the strait every day. And by March, that had fallen to roughly six. That's a 95% collapse in transits overnight as the conflict triggers suspensions from Maersk, MSC, CMA CGM, and Hapag-Lloyd within the first 48 hours. War insurance and coverage was then withdrawn effective the 5th of March, at which point the economics of transit became prohibitive for virtually all commercial operators. Um, as of late May, traffic is still running at around 5% its pre-war average. Over 1,500 commercial vessels are stranded in and around the strait. Um, while the Strait of Hormuz only handles around 2 to 3% of global container volumes directly, the bigger issue is around that 20% of global oil and LNG shipments that
Mhm.
flow through it. And as we've seen, fuel costs rise across the board have consequences beyond the Gulf. On the Shanghai Jebel Ali route specifically, rates quadrupled from under $2,000 to above $8,000 per container, and vessel rerouting to alternative UAE routes and have been waiting for 7 to 10 days. And across Gulf linked corridors more broadly, carriers have been adding surcharges of between $1,500 to $4,000 per container on top of base rates, depending on the carrier and the routes.
So a huge impact there. And I guess that spike we're seeing, that must be sort of the sort of brief moment of ceasefire where we thought we might have some more transiting returning. Yeah. Um, all right, very interesting. So you mentioned fuel a little bit there, Janan, but obviously this looks at the global perspective as well. Would you just like to take us through what's happened here, apart from the obvious gigantic increase in cost?
Of course. So following the escalation in late February, bunker prices just skyrocketed. And by early May, the global average had reached around $774 per metric ton. And that's up around 60% versus last year and 40% quarter on quarter. The reasoning here is fairly direct. As I've mentioned, this trade handles around 20% of global oil trade, and its effective closure triggered what the IE describes as the largest supply disruption in the history of the global oil market. The Middle East also supplies roughly 35% of fuel bunkered in Singapore, the world's largest refueling hub. Carriers responded by stacking emergency fuel surcharges on top of conflict premiums that were already in place. MSC, Maersk, CMA, CGM1, and Hapag-Lloyd had all announced emergency surcharges by late March, and some have revised them upwards multiple times within weeks. Slow steaming had helped conserve fuel, but it also took capacity out of the market at the same time as costs were rising.
Okay, very interesting. All right, well, we'll move on now to our ocean freight sentiment index, which is our cue also to launch our poll, asking you your thoughts on what you expect to happen to ocean freight rates over the next quarter. So please do respond there to give us your view. But while you're doing that, I will just explain the latest data from our poll here. So we're looking at Q2 really here, and on the Asia to Europe plane, we basically saw a 53.8% expectation of either a moderate or significant increase. So not actually a huge increase really, considering what's going on in the market, and actually comparatively small to what we saw in Asia to North America on the Trans-Pacific lane, where 70.2% of the respondents expected a rise in rates there. And actually, even on transatlantic lane, expectations were higher for 61.3%, expecting an increase. So really interesting that that lane, probably most you'd think affected by the Gulf, the expectations for rate increases were smaller. And I think just as a general rule for ocean freight there, we can see that, obviously at the immediate outset of the crisis, there was a huge expectation for a big increase in ocean freight rates. But, um, over the last couple of months, we've seen those trend down a little bit as people come to realize that the situation is sort of being managed. From a rates point of view, so that it's not quite as extreme as it may have looked at the time. And obviously, we've seen rates not really spiking as well. It's moderated that a bit. So quite interesting, really. But it looks like we've got most of our results in now. So I'm going to end the poll and then I'll share the results. Um, and yeah, I think they're broadly in line with actually the sort of level of sentiment we're seeing there. So we've got 56% of respondents saying it will increase slightly, 11% saying increase significantly. Um, yeah, broadly in line with the wider study. Vicky, what's your thoughts on that?
Yeah, so the results, the poll data is in line with our sentiment index. So 66% expecting rate increase. I would say that it reflects a relatively positive sentiment as we enter the third quarter, and I think it tells us something about how market participants actually view the balance between supply disruption and demand weakness.
Hmm. Yeah.
And I think, yeah, overall, it looks like the market has shifted from the more ambiguous sentiment we saw in the first quarter, where views um, were split to a more confident lean towards rate increases in the third quarter. And the driver is obviously the Middle East shock.
Hmm.
Yeah.
Absolutely. Well, then let's also compare that against our expectations then for rate development too, because of course part of the purpose of these reports is to show you what's happened, but also what's going to happen as much as we can. And this is the global outlook, but we do actually do these by trade lane as well if you want more granular data, and that's all included in the full report for subscribers. Um, and if you've not seen one of these tables before, obviously all of these different metrics that you see listed on the left-hand side, they're all based on data we have within our dashboard on our subscription platform, TI Pro. But they basically show the lines, the arrows show the effect that metric is likely to have on rate developments. They don't show each metric, what it's doing. They show the effects on rates. So that's how you should read this. But on the bottom line, obviously, it just shows you what's happening with rates. And not surprisingly, you're seeing increases there for the next couple of quarters, um, driven by what we've been talking about. But what I'd like to do is just ask, firstly, Vicky, just to give a few sort of key thoughts on what are the main drivers of that from a demand side, and then we'll look at some supply side issues that are causing that as well with Janan. So, Vicky, if you could highlight some demand side issues, that would be great.
Yeah, I think we're in a very tricky spot here because the market is pulling in two directions at once. With regards to demand and inventory levels and consumer confidence, they pull in opposite directions right now because US inventories, they're lean and inventory to sales ratio is running below 2025 levels. And this would normally signal an imminent restocking that obviously will support container demand. But on the other hand, we have a US consumer sentiment, which is at record lows. And we also have tariff uncertainty, and this suppresses or postpones new order decisions. So the entire restocking trigger is being pushed back. So overall, I think if confidence improves in Q3, lean inventories will generate a meaningful demand spike. But if it gets worse, shippers will keep their inventory strategies conservative. And yeah, and then the structural overcapacity we're seeing in the market will exert greater downward pressure on rates.
Indeed. And Janan, from a supply side, anything else you'd like to add?
So on the supply side outlook, as Vicky mentioned, there is a gap between fleet capacity growth, which is growing at 3.2%, and containerized trade growth at 2.3%. And the gap generally points towards continued downward pressure on rates as a baseline. So we expect downwards pressure in terms of capacity on the short to medium term, but even with that downwards pressure, the Middle East conflict is slightly complicating the picture. Like I mentioned earlier, the order books are significantly up, so oversupply will be a recurring theme in the short to medium term. On the fuel side of things, Brent is currently forecast to average $86 a barrel for 2026, and that is up sharply from $69 last year. And if Hormuz routing normalizes in Q3, we'd expect some easing, but pricing will remain sensitive to how quickly Middle East refining capacity and onward transport recovers, and just the geopolitical situation in addition to the continuity of a ceasefire.
Mm. Yeah. So, I mean, I'm getting some really great analysis from both of you there, but also overwhelmingly just so much uncertainty in the forecast period as well. Really, it could be this, could be the other. So, that's the reality of the situation at the moment. So we can't really forecast the geopolitical part of this equation. So, all right. Well, that was the easy one because I think air freight is even starker really at the moment in terms of what's the disruption is doing, and we'll take a look at that really closely in the Gulf as well, just like we did for ocean freight. But to start with, we'll look at the global picture for air freight rates, and if Vicky, you could highlight the sort of key developments here, that would be great.
Yes. So air freight rates surged to multi-year highs, and unlike the ocean market, this is primarily a supply side a story. So you can see from the chart, global air cargo rates in April were up 30% year on year. So that's the highest level since October 2022, before easing slightly in May. And three things drove this. First, Gulf airspace closures, which eliminated a substantial share of belly capacity virtually overnight. And then jet fuel prices, which, as Janan mentioned, they more than doubled from pre-conflict levels. And then the third factor were the rerouting. So airlines were rerouting through alternative corridors, which added flight time and reduced payload efficiency. And yes, the ceasefire in April did bring partial airspace reopening, and May data shows some easing. But carriers have still been quite slow to reduce the prices given the uncertainty and the fragility of the ceasefire.
Yeah, thanks, Vicky. And yeah, I think I did think whether we should possibly shorten this chart's timeline a little bit so we don't have the COVID spikes for rates because it almost makes the current increases look insignificant. But I think it's still worth remembering that that is still a very significant change in pricing in spite of the COVID spikes that also feature on that chart. So that's the overall rate picture. We've also got, of course, the underlying volume picture as well. Obviously characterized by volatility in air freight always. But Vicky, can you just take us through really what's happened volume-wise for air freight?
Yes, so the volume picture is one of strong underlying demand. February started quite well. IATA data showed a cargo demand growing 11% in February, but then the conflict hit and March saw a contraction in air cargo demand of around 5% year on year. And again, regional performance was quite uneven. Asia Pacific remained the strongest demand driver, especially in semiconductors, in electronics, and e-commerce. But then North America, it contracted, and this reflects, as I mentioned earlier, softer US consumption, but also the de minimis rule changes, which drastically reduced high frequency small parcel e-commerce volumes, which were quite a significant driver of volumes on this trade lane. So overall, demand remains supported by e-commerce, high-value manufacturing, and trade diversification.
Thank you, Vicky. And we'll move on to the capacity situation as well. And Janan's going to walk us through what's happened here.
Thank you, Michael. As a result of the conflict, IATA data shows international available cargo ton kilometers as being down 6.8% year on year in March, and cargo ton kilometers down 5.5%. Emirates suspended all Dubai operations, Etihad halted Abu Dhabi flights, and Cathay pulled its Middle East services. Um, Aviation Week reported that 3,400 flight cancellations happened across seven Middle Eastern airports in a single day on the 1st of March. Um, this matters because, as Vicky touched upon earlier, belly capacity is an important component of air cargo supply, and the Gulf hubs are critical connecting points for Asia to Europe, so capacity loss rippled well beyond the immediate conflict zone. Nine major Middle East airports collectively lost around 620,000 tons of cargo across March and April, which is a 52% year-on-year decline. March volumes fell 59% year-on-year. April showed some partial recovery but remained 43% below prior real levels. However, in the global picture, things are on the up. In April, CTK's international cargo traffic expanded 4% year on year. And as we've seen in the volume picture, Asia Pacific carriers were leading at around 11% growth.
Thing. Now, I think we'll move on to the Middle East section as well here and brace yourselves for this chart because it's as dramatic as you might expect. I'm just showing rate development since the onset of the crisis here. So that's quite an easy line of analysis, Janan, really, I think. But if you just like to try and explain a bit more context about what's happened here, that'd be great.
Of course, as we can see, rates from North America into the Middle East, as well as rates from Europe into the Middle East, took a mountain climb. On the North America to Middle East route, rates averaged $4.60 per kilo in May, and that's up 13% versus April, 71% versus the last quarter, and almost double versus last year. Um, that reflects a combination of things, rerouting costs, longer transit times, and cargo capacity that was just tighter because of Gulf airspace restrictions cutting off the most direct routes. Europe to Middle East rates tell a similar story. They averaged $3.90 per kilo in May, up just under 2% versus April. However, they were doubled versus last quarter and up 120% versus last year. So while things had begun to stabilize a little by May, the damage done across the quarter as a whole was severe. Qatar Airways gives a useful ground level perspective on what this has meant operationally. The airline has reported a 7% drop in annual profit for full year 2025-2026, and it's directly attributing it to airspace closures and the disruption of Doha's role as a global transit hub. They said they're actively rebuilding their international network after widespread cancellations. The through line, I guess, across all of this is the same: reduced aircraft utilization, longer routings, elevated fuel costs, and constrained capacity. And until those pressures ease, Middle East air freight pricing is going to stay well above where it was before the conflict.
Hmm. So the next chart will show us a little bit about how those pressures are developing as well. A really interesting one looking at recovery really and the movements and the impact on other lanes as well. But could you just take us through some key highlights on this one, Janan, as well?
Of course, as we can see, Overall activity in Gulf airports fell by over 99% overnight on March 1st. Freight activity in particular fell 86.5% in the first week of March and remained 78% below baseline across the month as a whole. Flight Radar 24 recorded just 21 total aircraft movements at Dubai International on the 2nd of March. Just 5 days earlier, on the 27th of February, there was 1,262. So the airport essentially stopped functioning overnight. Doha saw a similar picture with flights cancelled at Hamad International since the conflict began. By April, Gulf freight movements had recovered around 50% below pre-war levels, so the region was still running at half its normal throughput 2 months into the conflict. May was broadly flat, and as in April, it was just under 50% below baseline, which suggests recovery has stalled rather than continued. Um, During this crisis, airlines pivoted to alternative routing through other hubs to maintain Europe-Asia connectivity. Freight movements in the Caucasus airports, for example, were 41% above pre-war baseline in the first week of March and rising to 64% above baseline across the month. And they peaked at nearly 70% above pre-war levels in April. Middle East international traffic was still down 18.2% year on year in April, and available capacity was also down globally by 0.4% versus last year, as IATA reported. So massive Middle East capacity cuts outweighed expansions across Asia Pacific, Europe, and North America.
Interesting, as it's the knock-on effects shown very clearly there as well. Right, so we are then back onto the supply side, and well, here's the jet fuel chart. More massive rises there, although things seem to be coming down a bit. Janan, can you take us through what's going on here, please?
Of course, pretty stark picture here compared to expectations at the start of this year. The global average jet fuel index reached around 470 points in May, and that's up 141% year on year and 180 points quarter on quarter. During March, at the height of the conflict, prices more than doubled, and following the closure of the strait, prices peaked well past $595 per megaton. The global average jet fuel prices, though, last week fell 11.4% compared to the week before at $140 per barrel, which does suggest that some stabilization following the ceasefire, but the price is still above last year's levels by almost 60%. So it's substantially elevated relative to where prices were before the conflict. Airlines have responded with war risk surcharges, and IATA estimates fuel now represent around 30% of operating expenses, a significant additional cost pressure on top of the capacity constraints we've just discussed.
Hmm. Thanks, Jan. I think if you want an illustration of the extremity or extreme of this crisis, it's that this chart dwarfs the COVID crisis on fuel prices compared to, we're looking at rates overall. So this is, I think, where it's really biting, and obviously the knock-on effects for the supply chain are significant. All right, we're on to our sentiment index. So this time around, we will run our Q&A again. So not our Q&A, sorry, our poll. I will open our poll so you can give your responses. But whilst you're doing that, I'll just talk you through exactly what the survey currently shows. So um, pretty much a unified view, not that different across the three lanes compared to the ocean freight one anyway. So Asia to Europe, 73.1% expect an increase, and the vast majority of those are expecting a significant increase. So quite an intense expectation of increases over the last quarter there for Asia to Europe. Um, Asia to North America, again, it's actually slightly greater expectation of increasing rates at 73.3%, expecting an increase in rates. A marginal, but even more expectation there. And on the transatlantic lane, we've got 65.1% expecting an increase in rates. So I mean, pretty clear the broad direction of market expectations for rate development there. And looks like most of the poll results are in, so I will close the poll now and share the results with you. Um, I'd say based on those, we're just 64% overall expecting some kind of increase. That's, marginally down compared to the way the index was looking, um, based on the whole quarter. But obviously, that's probably looking at current expectations, from you, having just given the results. Um, what are your thoughts on that, Vicky?
Yeah, so overall, we can see that the air freight sentiment is strongly tilted toward further rate increases. Yeah, I think given the the stickiness of rates, I know that we mentioned that there has been some easing in May, but they're still quite high. So I would say this suggests that respondents and pool participants are right to anticipate ongoing rate spikes.
Yeah,
Yeah.
I think all the evidence pointing that direction, really. Um, All right. Well, we'll move ahead to the outlook as well here. So this works just the same, in just the same kind of way as the ocean freight grid. So bottom line showing the overall effect, and then the effect of each metric above. And as you can see, through Q1 and Q2, we're expecting substantial increases in rates, and still expecting, moderate inflationary pressure on rates as we go through the rest of the year there, really. But again, I'd invite Vicky, first of all, to give a few highlights on the demand side as to what's driving this.
Yes, so I think the best case for the third quarter is our modest rate increases compared to the second quarter, with the direction determined more by geopolitical developments than by demand fundamentals. Um, because the market has shifted from a demand-driven to a supply-constrained dynamic. So that means that the conventional forecasting tools like GDP, inventory ratios, and purchasing managers indices, they are less reliable now than they normally would be. And on the latter, also on inventory levels in particular, I mentioned that US inventory to sales ratio are low, and this would suggest higher air freight rates, because when the restocking happens, time-sensitive cargo tends to move by air first. So air rates could see a sharper spike than ocean if consumer confidence recovers.
Okay, thank you, Vicky. And Janan, on supply side, what do you think are the most important factors here?
The supply side picture is heavily dependent on the risk environment, and if the risk environment persists, higher fuel surcharges will continue to amplify the upward rates pressure that capacity disruption is creating. But there are genuine signs of recovery to point to. Emirates had restored 96% of its global network by early May, and Qatar Airways announced 12% capacity additions through new freighter destinations and restored frequencies. And the latest ACTK figure came in for April at just about 0.4% decline, and that is a significant improvement versus the month before at almost a 7% decline we saw in March. Um, but there was a wrench thrown in the works of recovery, just as when the situation in the area was cooling and recovery was starting to take shape. Strikes in the early hours of Wednesday morning destroyed large parts of Kuwait International Airport, and that has spiked tensions once again, putting all the airports in the vicinity in the Gulf on higher alert. Bahrain also closed its airspace entirely after interceptions the same day, forcing aircrafts operating in the area into an even narrower highway. And that's just a reminder that recovery in the Gulf is not linear. Every time the corridor starts to reopen, the risk environment just reasserts itself. Um, on overall picture, freighter capacity additions are limited by aircraft delivery delays and an aging global fleet. And so the market remains heavily dependent on belly capacity being restored, which itself is contingent on passenger route confidence returning to the Gulf. And on the labor shortages front, the LPA, the Global Pilots Union body, has called for pilots to have a non-negotiable right to refuse conflict zone operations after widespread reports of crews fearing sanctions if they turn down assignments. And that tension between commercial pressure and crew safety is going to create some scheduling and rostering constraints on effective routes for as long as the risk environment persists, really. So the key variables to watch here are the durability of any ceasefire and the possibility of re-escalation. And until those questions have clearer answers, tight capacity, elevated surcharges, and longer routings are the baseline assumption.
Very good. Well, thank you very much for sharing your views on both the ocean and air freight markets development throughout the webinar. Big Janam. We'll move on now to our Q&A session. So um, if you have any questions, please do feel free to ask via the Q&A panel. Um, and we've got a few in already, so let me just see what questions we have here. First one on ocean, looking at the Trans-Pacific route. So how should we be thinking about contract versus spot rate strategy for the rest of 2026? Bit of a broad question there, Vicky, but sounds like one for you.
Yes. So I think the answer depends on the volume certainty and how much risk the shipper is willing to take. But overall, I would say that the current environment suggests that a mixed approach is more sensible because contracts do offer cost predictability and they offer space guarantee, which matters a lot on the Trans-Pacific lane, given how quickly spot rates can move. So if shippers have reasonably predictable volumes, locking in a portion of those volumes through contracts will protect them from further geopolitical driven spikes. But that said, spot rates on the Trans-Pacific line are still 20% below 2025 levels. So that means that if the Middle East situation worsens or if peak season volumes are stronger than expected, spot rates can go up, and this is why the most practical or the most sensible approach would be to cover the baseline volumes through contracts to guarantee space and to manage costs while keeping some flexibility on the spot market for less than time sensitive shipments or overflows. And then final thing, I think the key thing to watch will be carrier strategies and the carrier blank sailings disciplines. If carriers start reintroducing capacity aggressively, that means spot rates could soften, and obviously you'd want some exposure to that. But if carriers maintain their blank sailings discipline, that means that contracted rates will probably look increasingly attractive as the year progresses.
Yes, and if I may just make a tiny plug here, I think if you want to read more about those kind of purchasing strategies, you can read our freight procurement trends report, which just came out a couple of weeks ago, with a survey of shippers and their purchasing habits, preferences, behaviors, that kind of thing, all around contracts. Very interesting. So do check that out. Um, Right. We also have another question here asking, do you attribute the cost rises we're seeing to the demand or supply side when it comes to uh, buying freight? Well, it's usually a mix of both, obviously, but in this case, well, I'll let Janan answer what she thinks are the biggest drivers of cost increases or price increases there. What are your thoughts, Janan?
I think this quarter, the supply side cost pressures are most likely what's driving the rates increases, and it's largely due to fuel prices and other risk premiums associated with shipping at the moment.
Yeah, pretty clear cut, I think, a supply side crisis. Um, all right, and another question on the crisis, actually. looking at the Gulf specifically, but quite interesting to look at the situation there. And this question hits it on the head. So, how is freight actually getting into the Gulf at the moment? What are the main ports of entry or alternate ports of entry? Perhaps another one for you, Janan, there.
The short answer is slowly, expensively, and via some fairly creative workarounds.
All right.
Um, so the primary shift has been to overland routes. So to get to the Arabian Peninsula, ships are heading to the other side on the Red Sea, which still carries some risk, through the port of Yanbu and neighboring ports in Saudi Arabia, and then onwards via truck to the rest of the Gulf countries, and also via open ports in Oman and the only two ports in the UAE that are not inside these straits, as well as Turkey, which has emerged as a viable alternative, a safe port per se. We do see a genuine winner in this disruption. Turkish ports hit an all-time high for any April on record this year, and they handled around 48 million tons of cargo. Foreign arrivals into Turkish ports were up 11% year on year in April. And it all comes down to geography, really. They have the Mediterranean and Black Sea ports on one side and land borders with Syria on the other, and thus making it a natural relay point, sort of between Asia and Europe when the Gulf routes are closed. Um, there is also a modal shift. High value cargo that counterweight is moving by air.
Yes, a long old route on from Turkey down into the Gulf, but I suppose it needs must. And yes, on modal shift again, that's another excuse to plug the procurement report where you get lots of data on that shift as well. I've also got another, and this is again probably one for you, Janan, but I think this is a really interesting question for the future of the market. So this is saying when the Straits of Hormuz do reopen, hoping they do ocean freight rates actually correct back to where the structural overcapacity would suggest they should be, or has this conflict permanently embedded a risk premium into Middle East lanes? What
Um,
are your thoughts on that?
that's a good question, and I think here we need to look back to look forward. Uh, in 1991, the Gulf War, it's a useful reference point. Um, when Kuwait was invaded by Iraq in August, war risk insurance premiums spiked. But once the conflict ended in February, they came back down relatively quickly, within months, not years. The same pattern repeated after the 2003 Iraq invasion. Rates peaked and then normalized to around 0.5% of hull value within about a year. So historically, the answer has been yes, rates do correct once the shooting stops. 2026 is sort of a different context. Insurance underwriters have now absorbed three major disruptions in 5 years: the Black Sea, the Red Sea attacks, and now Hormuz. There is a possibility that it might place the region as a structurally elevated risk and the floor gets raised slightly. However, looking at the historical context, it's unlikely that rates will stay this high.
Okay, thanks, Janan. All right, the last question, I think for the day is on surcharge stacking. So, how are other shippers handling the surcharge stacking? Is there room to push back on carriers, or is this just a cost we have to absorb right now? Um, One for you, Vicky, I think.
Yes, so the surcharges, Janan mentioned these surcharges, carriers imposing fuel surcharges on top of conflict premiums or on top of peak season surcharges. The thing is, in reality, it's quite difficult to push back because these are genuine cost increases for the carriers, right? They're not manufactured, but there is some room to push back on certain aspects. For instance, shippers can challenge the frequency of adjustments, the size of adjustments, because there have been some examples of carriers revising their surcharges multiple times within weeks. So requesting more transparency on the calculation basis is quite reasonable. And then for high volume shippers, they can use that leverage to cap surcharge exposure, or to agree a fuel indexing mechanism. And then a third thing that shippers can do is look at whether their contracts have any surcharge caps or review clauses that were negotiated before the conflict. And then one final point is that these surcharge stacking tends to be slow to unwind on the way down. So if and when fuel costs start to ease, start to drop, it's important to actively monitor whether carriers are passing that through at the same speed as fuel costs decrease. So that's often where when the real negotiation happens.
Ah, okay, I see. Really interesting. Very interesting question actually, and good to look at how that negotiation really works in times like these. Right. Well, thank you very much for your questions, and Vicky and Janan for your really insightful answers there. So that's the end of our webinar today. But obviously, if you want to continue the conversation, ask about any of the insights or data shared today, you can do so using the contact details on your screen there. Of course, you'll all be sent the reports and a recording as well, so that you can dive into it all in much more detail too. But thank you again for joining, and thanks to Vicky and Janan for joining and sharing their views as well. And we shall see you next time. Goodbye.